Yes, good morning, one and all. How are you all? I'm doing good in case you're asking. Hope you're all doing good as well. So thank you for joining with us today in this wonderful morning. So hopefully the session is going to be fruitful for you. So again, before I get started, can you give me a quick confirmation? Is the audio part and the video part clear, people? Final confirmation before we start. Good morning, good morning. Yes, audible, everything good. Okay, awesome. That's great, people. In the live streaming, there will be a few seconds delay, people. Okay, so I'm just going to run through, or just give me 1 second. All right, so without delay, so let's get started with our first session on CA final IND AS or FR subject ka marathon batch. Okay, so I know that there is a lot of hoopla or drama around the postponement of exam due to elections. Okay, so let's not worry about those things, people. These are something which is not within our hands. What is within our hands is probably only our preparations. Yes. So let's get started with our preparations. So if by chance exam gets delayed, most probably it will. All right. Okay. So whatever, take it as a bonus time and revise it 1 or 2 times extra. Okay. Because of that, don't delay your preparation. Just because few days extra you got means don't start chilling it out. Okay. All right. So let's get started with the first topic in our revision session, that is IND AS 16 property, plant and equipment. Or maybe one more pointer before we start into this topic. People, we are doing a revision session. So one of the requirements or prerequisites of attending or watching revision session is once you should have ideally studied all the topics. Okay. So if you have studied, the revision will be more effective. So I will only watch this marathon class and I will pass. Is that possible? See, that is not a good strategy or a recommended strategy. Okay. If at all you have landed in that scenario, okay, so anyway, I'll try my best to cover everything because in marathon, you know, our regular batch of FR almost went for around 320 hours. Now that 320 hours topic, I'm trying to sum it up in about 25 to 30 hours. So that is the kind of the bandwidth that I've kept for this particular revision batch. So you can almost visualize 330 hours ka content in about 30 hours means. So all the concepts I'll be able to cover it. But problems also will be doing, but not to that extent as we used to do it on our regular batch. Okay. And the pace also, pace of this particular revision batch also will be a little faster when compared to our regular class. Hope that is understandable for everybody. Yes, because we have to cover everything within that 25-30 hours. No, that is the reason. All right. Yes. So this, I wanted to upfront disclose this with you. Now, can we dive into the topic, people? Okay. The first topic for today is IND AS 16 property, plant and equipment. And again, all the concepts we will study with the help of this colored chart book. Okay. So if you want to purchase these chart book, I'm sure those of you who have taken regular class from me are aware of this particular chart book. So those of you who are watching me for the first time, first of all, I'm called CA Sandesh. Okay. So that you should not forget it. So that's the reason I've written my name in every page. All right. So thank you for joining with me. So if at all you want to buy these books, you can purchase it from our website, learn.arivupro.com or online.arivupro.com. There it's available. You can purchase it. If you have already purchased it, you can sit with that book. So it will be helpful for your revision. Okay. All right, people. The first thing is property, plant and equipment. Sir, if you want to call something as a property, plant and equipment, it has PPE means it has 3 features. Those components which satisfies 3 features, we call it as property, plant and equipment. 1, it should be a tangible item. Tangible item means you should be able to see, touch, feel. It should be held for use, meaning that PPE, you should use it for what purpose? Either to produce goods or to render a service or administrative purpose or rental purpose. For one of the 4 purposes, you should use that PPE. That is what we mean by held for use. and this usage should be for more than one period, meaning it should be for more than 12 months. If all the three features are satisfied, then we call that component as PPE, as in property, plant and equipment. Okay. But if you want to show this PPE in balance sheet, this is the features of PPE. But the same PPE, if you want to show it in balance sheet, there are two recognition criteria. Those two recognition criteria are FEB and cost measurement. So what is FEB? FEB means future economic benefits. Due to that property, plant and equipment, some benefits should flow to the entity. It's not necessary that the benefit you should receive it today only. If you are expecting to receive benefits in future, that is also acceptable. Okay. There has to be some benefits flowing to the entity because of this particular PPE. That is one recognition criteria. And second one is cost measurement. How much you have spent for this PPE, you should be able to measure it reliably. If all these are satisfied, then you can show PPE in balance sheet. That means in totality, if you want to show PPE in balance sheet, 5 criteria should be satisfied. One, it should be a tangible item. It should be held for use. Usage could be either to produce goods or rendering service or administrative purpose or rental purpose. And the usage should be for more than one period, meaning for more than 12 months. Okay. And then because of that PPE, some benefit should flow to the entity, and how much you have spent towards that PPE also, you should be able to measure it reliably. Okay. So what about this use, sir? First usage, I think it's pretty much self-explanatory. You should use this product to produce some goods. Like a factory machinery is there. Factory machinery company uses to produce some goods. Okay. Or rendering service. Like here, we are using laptop, iPad, etc., not to sell any product, but to render a service, a teaching service. That is your service aspect. Another one is administrative purpose. Even administrative assets are also property, plant and equipment. If you check in many companies, they'll have this furnitures like sofa set, tables, chairs. Like in our own academy, if you just see, we have AC installed in receptionist area. If you install AC in a classroom, then the classroom is used to provide a service, right? So that AC is deployed to give a service. But the same AC, if we install in a receptionist area, we don't conduct any class in receptionist area. Yes. But still, it is necessary for administrative purpose. Even administrative assets are also called as PP. In fact, majority of the assets in the organization fall into this administrative category. Okay. Last one is rental purpose. If you are holding any assets for renting it out, then that will also be considered. More about rental purpose, we'll study in IND AS 40 investment property. Okay. This is about PP and its recognition criteria. Okay. One more thing is bearer plant. Okay. Bearer plant means, sir, a plant which satisfies 3 criteria, we call it as bearer plant. If it is bearer plant, IND AS 16 very much applies. First of all, if you go one step back, it says IND AS 16 is not applicable for biological assets. Biological assets means plants and animals. Plants and animals, we call it as biological assets. For this, IND AS 16 is not applicable. There is a separate standard which we already know, which is IND AS 41 called agriculture. All right. But if it is a bearer plant, then IND AS 16 apply. For all the plants, IND AS 41 applies. Only for bearer plant, IND AS 16 applies. Okay. So that's the reason now we need to know what is a bearer plant. So bearer plant means it is a plant which satisfies 3 criteria. One, it must be used in the production or supply of agricultural produce. Meaning from that bearer plant, you should get some agricultural produce. Let's take an example. In a class, if you see, I used to give mango tree example. Okay. So is mango tree a bearer plant is what we are trying to check. Sir, if a farmer is cultivating mango tree, what does he get out of mango trees? He gets mangoes. So mango is not an industrial produce. Mango is an agricultural produce. So condition number 1 is satisfied. If you want to call it as a bearer plant, you should get some agricultural produce from it. Second, it must bear the produce for more than 12 months. If you have a mango tree, will the farmer get mangoes from that mango tree only for 1 year or more than 1 year? Generally more than 1 year. Meaning the produce, you should get it for more than 1 year. 3, it has the remote likelihood of being sold as agricultural produce except for incidental scrap sale. Okay. So basically that tree, the farmer, once he gets mangoes from the mango tree, he will obviously sell mangoes. That mango becomes inventory. That's fine. But farmer ka business should not be to cut the trees and sell that tree to the timber industry. Like if a business of a particular farmer is, he will grow a mango tree, get mangoes, sell the mangoes. After he sells all the mangoes, he'll cut the tree also and he will sell that tree to the timber industry. That should not be the case. All right. So if you want to call it as bearer plant, normally PPEs and all, we don't sell it in regular course. We try to protect them. Only if it turns bad, like here, my laptop. right? I don't sell my laptop everyday basis. If laptop is not working as it should, then I will sell it and buy a new one. Yes or no? So I mean, this bearer plan, you should only sell it as a scrap sale and not as an ordinary course of sale. That's what this criteria means. Okay, so if all the three are satisfied, then it is a bearer plan, and bearer plan will be accounted as per IND AS 16 itself. Okay, people? All right. Next one. Sir, cost. Sir, initially, all the property, plant and equipment are measured at cost. Initially, when you buy, all the property, plant and equipment are measured at cost. So what is cost for this purpose we are trying to study? Okay. One, purchase cost. The first component of cost is purchase cost. If I buy a machinery for 1 lakh, that 1 lakh becomes your purchase cost. So purchase cost forms a part of your initial cost. Then if you have any trade discount, reduce it. If you have any non-refundable taxes and import duty and all, add it. Okay. And if you have any directly attributable cost means those costs which are necessary to make the asset management ready. Okay. Because sometimes we don't use the asset as it is. Like let's say I purchased a building. Just because of purchase, we will not start using it right away. We will do some interior work, right? Some vastu changes and all we will do. Yes, some customization we will do. All that customization charges, we call it as directly attributable cost. Or in other terms, if I buy a machinery if it is complex, we may have to install it also. So there's installation charges, delivery charges, etc. We call it as directly attributable cost. Even they can be added. I've given you certain examples of DAC as such over here. Okay. And even testing charges forms part of DAC. Like if you have machinery, from that machinery, let's say you have a plant and machinery. From this plant and machinery, you are producing a product called product A. Okay. This product A straight away will you sell? No. First, you will check whether product A is functioning the way it should. Before you start selling this product A in the market, first you will check whether it is functioning properly or not. That means you will do some testing, yes or no. Correct? Let's say to do the testing charges, you incurred, let's say 1 lakh rupees. Okay. Let's say the testing finding is, yes, product A is functioning the way it should. Or maybe first phase, let's say first time, normally when you do the testing, normally, let's say it is a failure. Okay. We did the first time we did the testing by incurring 1 lakh as testing charges. Product A is not functioning the way it should. Okay. It is not up to expectations. Okay. Then this testing charges is necessary to make the asset management ready. So testing charges will be added. But however, let's say from testing, you got a faulty product. You did not get the correct product, but you got a faulty product. Let's say the faulty product, you can sell it for 80,000. Okay. That means you are getting some sales proceeds out of that testing charges. Yes, no. So if you have any sales proceeds from the product tested, that has to be deducted. Doesn't matter what the amount is. Here testing charges is 1 lakh. The sale value is 80,000. That means net may all capitalize only 20,000. Okay, other way it could also be like this only. Testing charges could be 1 lakh. Let's say sale of the product tested could be, let's say 3.5 lakh. Hypothetical. If it is so, don't bother. 2.5 lakh rupees net amount you will not add to PP. Rather, you will reduce from PP. Whatever is the sale proceeds from the product tested, simply reduce it. Okay, that is your DAC. So purchase cost, then DAC, and another one is DSR cost. DSR cost for decommissioning and site restoration cost. So if you have any DSR cost, you can add that as well. So what is this DSR? So if you remember our classes, I used to give telecom tower, JioCar telecom tower example. One second. Okay. Now let's say Jio, right? Obviously, if they want to, let's say JioCar SIM, mobile connection. So if they want to achieve more customer base, that means their signal has to be good. To get good mobile signal, they will install telecom towers. Have you seen big structures? Those telecom towers are not installed on the road. They're normally installed on a high-rise building. Let's say one telecom tower of Jio, let's say it cost about 10 lakh rupees. It was installed in one of the apartment building or one of the residential building. Okay. The Jio told the building owner that if you give us a permission to install this telecom tower in your office, we will give you a rent. Let's say 1 lakh rupees per month, or per annum, we will give you rent. Building owner said, yes, no problem, take it. But building owner also told what happens, let's say the life of this telecom tower is 5 years. Building owner, let's say, asked the Reliance guys, what will happen after 5 years? Reliance people told, till air route, or we will pluck those telecom tower and install a new one. Okay. Then building owner asked, what happens to my building then? Will there be any damage cost? Reliance told, of course, there will be some damages. Now, what do you think building owner will say now? Boss, my building was proper only. You came, you installed some telecom tower, and now you're saying later on after that you'll uproot or you'll take away that telecom tower. So due to this, there will be some damage cost, right? Let's say the damage cost is 50,000. This 50,000 damage cost, we call it as DSR. The building owner obviously will say what to Reliance. You have incurred this or you have caused this damages, so you only repair it. So Reliance guys have to incur this 50,000 charges to repair charges. That repair charges we call it as decommissioning and site restoration cost. Even this can be capitalized, because if the Reliance guys do not repair this or do not incur this means, will building owner give permission to the Reliance guys to install this telecom tower in their building? No. That means for this telecom tower to operate the way Reliance wants it, this particular DSR cost is necessary. That means indirectly this is also what? DAC only. But the main difference between DAC and DSR is, so DAC normally comes at the time of initially itself. Let's say install DAC and all, example is installation charges. No? When you buy a machinery, you will install it. That means DAC and all will come where? In year 0 beginning or year 1 beginning itself. But this DSR cost will not come now. When in my example, this DSR cost will come after 5 years. Okay. Hence, there is a separate accounting treatment required for it. Okay. So what does AS16 say? Sir, you can't add 50,000. Basically, DSR cost, you can add it to the cost of PP. You can add it to the cost of PP. But entire 50,000 you cannot add. You have to find out something called present value of DSR cost. Use the discount factor and find out present value. Because this 50,000 is not the present value, it is the future value. Find out the present value. Let's say that is 30,000 assumption. Then now you'll only add 30,000 to the cost of asset. But we are paying 50,000, no sir. Yes. The difference between the future value and present value, 50,000 minus 30,000, which is nothing but 20,000. That will be your time value money interest charges, which will be transferred off to P&L account. In financial instruments, we do unwinding of interest. So unwinding of interest you'll have to do for this particular thing. Basically, the 20,000 is your finance charges or interest charges, which will be transferred off to P&L. So that is your DSR wala drum. Okay. These are about cost inclusions. So what about cost exclusion? So some costs are excluded from the cost of PP, like general administrative overhead, selling and distribution overhead, any sort of promotional expenditure, user training cost. If you're giving any training to the employee to use an asset, okay, asset is already ready for use. By giving the training, user becomes ready to use. Hence, this user training cost also will be transferred off to P&L. It will not be capitalized. It will be transferred off to P&L. Like this, if you have any relocation cost, reorganization cost, etc., all that again will be transferred off to P&L account itself. One more thing from this you need to remember is your incidental operation. Let's say there is a land on which I need to construct a building, right? I've not yet constructed the building. Okay, the construction, let's say, will start after 7 months. I have a land already. Construction will start after 7 months. I thought, why to keep that land idle? We'll let it out. We'll give it to somebody as car parking space. That land was let out. Okay, and let's say we are getting some money. Let's say we earned about 1 lakh rupees by letting out this as a car parking space. That 1 lakh we're calling it as incidental operation income. That will not be added. Rather, this 1 lakh will be transferred off to P&L. Okay, it will not be added or subtracted, but 1 lakh will be straight away treated as an income and transferred to P&L. This is about the cost, initial cost basically. Okay. All right. The next part is, excuse me, later on, what if you have added? Okay. If there was an asset, okay, you did some additions. In that case, what do you have to do? Check if recognition criteria is met. What is recognition criteria? FEB and cost measurement of PP basically. Yeah. If recognition criteria is met, then you can add it to the cost of the asset. If it is not met, transfer it off to P&L account. Okay. That is one. Another one is this replacement cost. This could be important because we have some questions relating to this. Maybe one such question, I'll take it up now. Replacement cost. Let's say you have replaced some parts of the machinery. Okay. All right. Let's take a small example here. Sir, let's say there is an electric car. This car, no sir, has, let's say, 2 main components. One is battery and then is the other parts. Okay. Let's say other parts ka life is 10 years. Battery ka life is 5 years. This car, overall the car ka life is 10 years, but battery alone will only come for 5 years. Now what IND AS 16 says is, if now one asset ka name is electric car, which is PP. If an asset has various parts and different parts have different useful life, means you need to charge depreciation also on separately. If the assets has different parts and if the different parts have different useful life, then depreciation for them needs to be calculated separately. Meaning, when you calculate depreciation on battery, you will charge depreciation for 5 years. When you're charging depreciation on other parts, the useful life you will take is 10 years. This concept we call it as component accounting. Meaning, if different components or different parts have different useful life, then it needs to be depreciated also separately. That means we go on passing separate entry or sir? No. Calculation of depreciation needs to be done separately. If you want one journal entry, you can pass for accounting purpose, but calculation has to be done separately. Is that okay? That is what we mean by component accounting. Okay, sir? Okay. The next part drama over here is, let's say over here, taking the same example little forward. Sir, when I bought the car, I thought this particular battery will come for 5 years. Let's say after third year, after year 3, Vastu problem, whatever, Rahu, Ketu problem, whatever problem, after third year, no sir, battery gone. Battery gone. We thought it will come for 5 years, but after third year only it is gone. That means we bought a new battery. In this case, what we need to do? Sir, new battery ka cost. You have done a replacement, right? Obviously, due to new battery, you will get recognition criteria is satisfied. You will get some FEB and cost measurement. So, new battery ka cost, you add it to the cost of PP. That is not the drama alone. You were depreciating this old battery over how many years? 5 years. But now you replace this after how many years? 3 years. That means, do you have any carrying amount of old battery? Do you have any carrying amount of old battery? Yes. Okay, that you need to reduce. Think logically. There is a car. In car, there are two batteries or there are only one battery. Now only new battery is installed. This old battery is thrown out, right? That means even this carrying amount of old battery should be removed from your books. So that is what I've written over here. All right. So derecognize, meaning cancel the carrying amount of the old part, and however the new amount of the new part or new battery cost can be added up. Okay. That's what this concept is all about. Okay. Same concept goes for your major inspection charges also. Sometimes when you're operating an aircraft or a ship and all, no, you need to undergo a major inspection. So major inspection concept is also same. So if you are doing any new inspection charges can be added. Carrying amount of old inspection charges, if at all, if it is remaining, which is not yet depreciated, that you need to reduce it. Okay. Let's do a thing. Let's quickly take up this concept. We learn this with the help of one question for Deferred. Question number 8. 1 second. Is the pace okay for everybody? Excuse me. All right. So let's get started with question number 8. MS Limited has acquired a heavy machinery at a cost of 1 crore rupees with no breakdown of component parts. So each part ka breakup is not available with the company is what they're trying to say. Okay. The estimated useful life is 10 years. All right. At the end of 6th year, 1 second, sir. Can you tell me what will be the carrying amount? Original cost was 1 crore. We are at the end of 6th year. That means what is the total depreciation you have charged so far? 1 crore, they have not given any residual value, divided by useful life is 10 years. So 10 lakh is the depreciation per annum. For 6 years, it will be 60 lakh. That means the carrying amount is 40 lakhs. Okay. The carrying amount of the asset is 40 lakhs. Fine. At the end of 6th year, one of the major components, the turbine, one component is that turbine, it requires replacement. You have to replace it. Great. As further maintenance is uneconomical. All right. The remainder of the machine is perfect and expected to last for 4 years. Other parts are fine. Only this needs to be replaced. The cost of new turbine is 45 lakhs. So what about new turbine ka cost? New turbine ka value you can add. That's not going to be a problem. Yes. Is that the only thing? No. Whenever you're doing a replacement, new part ka replacement cost you can add. What about the carrying amount of the old part? That we need to derecognize. Okay, but initially only they told, do you know the breakdown of parts? Each part ka value you knew at the beginning or not given? Not given. That means how will you find out the carrying amount of the old part? 1 second, there's a workaround. Let's read this. Cost of the new turbine is 45 lakh, discount rate is 5%. Can the cost of the new turbine be recognized? What is the treatment they're asking? Okay, so basically carrying amount of the old turbine. Carrying amount of the old turbine, we need to reduce it. But we don't know the amount. How to do it? This is a workaround. New turbine, how much does it cost? It costs 45 lakh. When does it cost? When are you buying this? At the end of year 6. Okay. That means old turbine. Can I say this is like the future value? Now we want old turbine ka cost means we want year 1 ka, right? So 6 years back you need to go. Now a new turbine is costing 45 lakh. That means 6 years before how much it would have costed. All right. So this 45 lakh becomes your future value. You have to use a discount factor. I think discount factor is given in the problem to be 5%. So discount factor is 5%. 6 years before how much is the value. So can you tell me what is the PVIF? So 1 divided by 1.05. 1, 2, 3, 4, 5, 6. The discount factor will be 0.7462. So that means the carrying amount of old turbine. Carrying amount, what is the cost of old turbine? 6 years ago, you would have purchased this turbine for, my calculator is showing 33,57,969. That's what they must have written somewhere over here. Okay, they've rounded it off, taken it as 900, take the actual number, it's okay. All right. So 6 years ago, when you would have purchased this turbine, right, it would have costed you this much. So can I eliminate this? No. This was the cost 6 years before. I've already used it for 6 years, no? So reduce the depreciation for 6 years. So basically this divided by 6 if you do. Okay, in fact, 33 lakh 57, maybe we'll round it off just to sync up with the solution. Divided by this useful life they've not told. So we'll take, when we initially bought it, since component was not there, this also we would have depreciated by keeping 10 years as a useful life. You've used it for 6 years. So do that. 33,57,900 divided by 10 into 6 gives us 20,14,750. This much you already depreciated. That means what is the carrying amount of the old turbine remaining? 13,43,229. 13,43,229, which they've rounded off to 160. That is the carrying amount of the old part at the end of 6th year. That you need to derecognize, meaning reduce it. So once you do that reduction, so basically here you need to reduce this 13,43,900. If you do this, then you will get the revised carrying amount of the asset, which is 71,56,840. Okay, so the takeaway of this particular example is what? Whenever you buy a new turbine or a new part ka cost you will capitalize, but the carrying amount of the old part should be derecognized. If they have given carrying amount of the old part, calculated normally. If they don't give, there is a workaround. What is that workaround? Here, new part was purchased after 6 years. So 6 years before how much it would have costed. Use discount factor and find it out. Then depreciate it for 6 years because you've used it for 6 years. Then you will get the carrying amount of the old part, which you need to eliminate or derecognize. So that is all this particular question is all about. Okay. All right. So let's come back now to the other one. Okay. What about spare parts? Spare parts. If you purchased any spare part, again, the rule is pretty simple. Check if the recognition criteria is met. If recognition criteria is satisfied, check if it is purchased along with PP. When you purchase PP also, you purchase spare part also. If that is the case, then you can add it to the cost of PP. You purchase PP in year 1. Spare part you're purchasing in year 3. If recognition criteria is met, then you will show it as a separate asset. This is ICA ka clarification. If recognition criteria is not met, then you will show this particular spare part as an inventory. Okay. All right. The next one. Next is consideration. Cash is pretty straightforward. If you purchased an asset by paying 10 lakh, is there any drama around it? No. Simply write PP account debit to bank, 10 lakh, drama over. Okay. There is no drama around that. What about credit? In credit, you have to check whether there is a deferred credit or deferred consideration. So what do I mean by that? Sir, let's say you purchased a plant and machinery. Okay. You want to purchase the plant and machinery. Let's say a particular vendor, the vendor from whom you are purchasing PP, sir, he is charging 10 lakh rupees for this PP and he gives you a credit period of 2 months. Okay. You can purchase PP from a particular vendor by paying 10 lakh and 2 months credit you will get. Okay. But you asked the vendor, I'll buy the machinery from you, but I'll not pay the money now. I'll pay after 2 years. Normal credit is 2 months, but you are asking how much credit term? 2 years. Now, do you think he will sell it at 10 lakh for you now? No. Now, let's say now the vendor told, fine, I can do this, but the price now for you is not 10 lakh. It's going to be 13 lakhs. Okay. That means now the question is, we are buying this asset by paying 13 lakh. Should we record this asset at 13 lakh or 10 lakh? India 16 says this is what we mean by deferred credit. Okay. We are not settling the amount now. We are settling it after 2 years. Okay. In that case, what India 16 says is you have to record the PP at cash price equivalent. Cash price equivalent, or you can call it a CP. All right. Meaning if you purchase the asset today under normal cost, how much it would have cost? Not for 2 years. Normal credit term is what? 2 months. So if you had purchased this PP under normal credit terms, how much it would have costed? 10 lakh. That means the PP will be recorded only at 10 lakhs. But are you paying 10? No, you are paying 13 lakhs. That means the difference between the 10 lakh and 13 lakh, which is 3 lakh, is nothing but your time value of money ka interest charges, which will be transferred off to P&L account. Meaning again, this unwinding of interest, which we used to do on our financial instrument topic, same thing will be transferred. So PP, you'll record it at 10. The difference between 10 and 13, you'll transfer it off to P&L account. Okay, that's what we mean by deferred credit. All right. Next aspect is the exchange. If you have done any exchange, meaning your purchase PP, all right. Normally what happens, sir? If you purchase PP, means PP will come in, cash or bank balance will go out. Yes. So this PP, we call it as non-monetary item. Non-monetary item means whose value fluctuates. Value is not fixed. Monetary item means the value is fixed. Like if you have 10 lakh rupees with you now, okay, then it's, what is its value? 10 lakh only. All right. If you have a debtor worth 1 lakh rupees, then how much will that debtor pay you? 1 lakh. So those components whose value is fixed, like cash in hand, cash at bank, debtors, creditor, bill receivables, bills payable, all that we call it as monetary item. Okay. Those components whose value fluctuates, whose value is not fixed, like property, plant and equipment. If today, if you purchase property, plant and equipment for 10 lakh, its value forever is 10 lakh only? No. Its value may be more later on. After 2 years, if you sell, its value may be more or its value may be less. So basically value is fluctuating. If value is fluctuating, we call that as a non-monetary item. Okay. All right. In normal course, what happens when you purchase a PP? PP will come in, meaning non-monetary item will come in, bank will go out. So there's also an exchange. We're not talking about this exchange. We are talking about other exchange. Let's say you purchased a plant and machinery. So this is coming in. This is the non-monetary item. All right. Instead of giving cash, let's say you gave building. Building again is what? Building is going out. Again, this is the non-monetary item. One non-monetary item is coming in, another non-monetary item is going out. So this scenario, we're calling it as exchange. If this happens, means how should you record is what India 16 is trying to say. Okay. All right. The simple thumb rule of exchange transaction is whenever there is an exchange, right, you have to record it at fair value. Whatever asset is coming in, that whatever PP that is coming in, no, should be recorded as a thumb rule at fair value. Sir, fair value need not be used. Fair value is not required under two circumstances. You need not use fair value under two circumstances. One, if fair value of both the assets are not available. Whatever asset is coming in, whatever asset is going out, both ka fair value you cannot find out. Or transaction lacks something called commercial substance. If transaction lacks commercial substance or if fair value of both are not determinable, then fair value is not required. So how can you say transaction lacks commercial substance? If you want to conclude transaction lacks commercial substance, then asset-wise cash flow and entity-wise cash flow has to be same. Asset-wise cash flow also same. Entity-wise cash flow also to be same. If both are same, then we say transaction lacks commercial substance. Sir, give us an example. Sir, let's say there is A Limited and then there is B Limited. Sir, A Limited, let's say, has an agricultural land. Okay. In one particular area. Okay. Let's say in Bangalore. All right. B also has an agricultural land. In Bangalore itself, same area, same locality. Aju baju wala lines. Okay. Both of them have a land next to each other. All right. They did an exchange. A did not like this asset. A liked this asset. B did not like this asset. He liked this asset. So they did an exchange. Maybe what's the problem? We don't know. Okay. They did an exchange. All right. Now what to do? Now you just check, sir. Both assets are there in the same locality, same dimension, everything. Both are used for what? Agricultural purpose. That means whether you use this land or whether you use that land, the benefit will be same. That is what we mean by asset-wise cash flow, same. Whether you use this asset or that asset, the asset-wise cash flow to be same. That is what. In this example, it is so, correct? Not only this, entity-wise cash flow also to be same. What does that mean? So let's say A Limited is using this agricultural land to grow wheat crop. But B Limited is using this agricultural land, let's say, to grow corn. One is using it for producing wheat, another one is using for corn. Now you tell me, a land which was suitable for corn, do you think it will be as suitable for wheat also? No. A land which has been used for corn for many years, its fertility is set to that tune. Now suddenly this land, if you use it for wheat purpose, do you think you'll get same benefit? No. This is what we mean by entity-wise cash flow also to be same. In this case, this particular land which A Limited was using, it was used for wheat purpose. Now this is gone for them and the corn ka land has come in. They are not, A Limited will not use this land now to grow corn. They will use it to grow wheat. That means will they get same benefit? No. So in this particular example, entity-wise cash flow is not same. Entity-wise cash flow is different. For you to conclude transaction lacks commercial substance, entity-wise and asset-wise cash flow to be same. Okay, in my example, it is not so. Asset-wise cash flow is same, but entity-wise cash flow is not same. Okay, fair enough, people? All right. So if both are satisfied, then you need not use fair value. So if you are not using fair value, what do you need to use? You'll use the book value. All right. If you're using fair value, you will end up booking some gain or a loss. Okay. So let's look at this with probably one example. Now check this. Question number 2. Pluto Ltd owns a land and building, which is carried in the balance sheet an aggravated carrying amount of. So there is one company, Pluto. They have a land and building whose carrying amount they are saying is 10 million. All right. And the fair value of this particular land and building they are saying is 15 million. Okay. It exchanges this land for a private jet. So land they are giving away and jet they are taking. Okay. That means this land ka cash flow and jet ka cash flow value same, sir. Whether you use land, whether you use jet, both will get same cash flow or different cash flow. Obviously different cash flow. That means here what is the case? Asset-wise cash flow itself is different. If asset-wise cash flow is different, I already gave you this thing, right? If you want to conclude transaction lacks or a transaction does not have commercial substance, 2 criteria should be satisfied. Asset-wise cash flow same, entity-wise cash flow same. Here, asset-wise cash flow is same or different? Asset-wise cash flow is different. That means this particular transaction has commercial substance. And if you have commercial substance, you will have to use what value? Fair value itself. So which fair value to use? Check. What is the fair value of this land? 15 million. It exchanges this land and building for a private jet whose fair value is 20 million. So jet ka fair value is 20 million and building ka or land and building ka fair value is 15 million. Which to use? So standard says whichever you can use, either asset given up ka fair value or asset acquired ka fair value, whichever is more clearly evident. Whichever you can find out more clearly, use that. But practically and for exams also, use fair value. Both are given means use fair value of the asset given up. Okay, because it is us, no. So our assets ka fair value we can find out more clearly. Hence that's the reason you use fair value of the asset given up. Here what was given up? 15 million. That's all. No, it pays an additional cash of 3 million. That means 2 things. If you write it as in and out. Pluto Ltd. What came in? Jet came in. What went out? Building went out. Cash went out. What is the fair value of the building, sir? 15 million. What is the fair value of the cash that went out? 3 million. That means what is the total fair value of the asset that went out? 18 million. That means this particular company will pass the entry as what? PP, that is jet account debit. To what extent? To the extent of fair value of the asset given up. What is the total fair value of the asset given up? 18 million. So you'll record it at 18. Okay. To what? Now we have to de-recognize or cancel building because it is gone. So to write to building. Building is shown in your books at what value? It is shown at a carrying amount of 10 million. So recorded at to 10,000. Okay, this is the entry over here. All right, that's all. No, you give away cash also. To write to cash, 3. Balancing figure is nothing but your profit or loss on exchange. In this case, it's a case of profit. So when you use fair value, there will be some profit or loss. Okay. So if fair value, both the fair value is not determinable. So there's the entry. Suppose in this problem, if they say both the fair value is not determinable. Okay, or maybe I'll tell you that example through IND AS 38. One more scenario is there we'll solve. Is that okay? So if both the fair value, if it is not determinable, means use carrying amount. Meaning when you're using carrying amount, you will not end up getting any profit or loss. Okay. Yes. So this was about the exchange drama. Okay. Next, go for the next. Self-constructed asset. So instead of purchasing the asset, if you have constructing your asset, the principles remains the same. Whatever cost is necessary for you to construct the asset, you can go on capitalizing. So there is no different drama for it. Okay. Then is depreciation. All right. So depreciation is, sir, you charge depreciation on PP. The same rule holds good for your amortization also. The rule is very simple. If you want to charge depreciation, 2 criteria should be compulsorily satisfied. 1, DA should be positive, and 2, useful life should be limited. DA should be positive and useful life to be limited. So what is this DA? DA stands for depreciable amount. So how do you calculate that? Depreciable amount is nothing but carrying amount minus residual value or salvage value or scrap value. Okay. So let's say the carrying amount of the asset is 10 lakh. Residual value is 12 lakh. That means how do you get, what is the DA here? DA is negative. So in this case, you will not charge depreciation, or in a way, indirectly I'm telling you, if residual value is greater than or equal to your carrying amount, then the depreciation will be nil. No depreciation is necessary in that regard. Okay. Again, fair enough. So depreciation ka 2 checkpoints we'll always check is 1, the DA should be positive and useful life to be limited. And how do you get DA? basically the carrying amount minus residual value. Okay. Now this DA only, suppose taking another example, let's say carrying amount is let's say 15 lakh, residual value is let's say only 3 lakhs. That means how much is this? DA is 12 lakh. This, let's say, useful life of the asset is 4 years. So what is depreciation is, if you look at the very definition of depreciation, it says depreciable amount, that is DA, should be allocated on a systematic basis over the useful life of the asset. So if DA is positive, this 12 lakh only you will transfer it to P&L in the name of depreciation. This 12 lakh only you will transfer it to P&L in the name of depreciation. 1 year P&L, no. This 12 lakh you will transfer it to P&L over a period of 4 years. That means what is depreciation? 12 divided by 4, which is 3 lakh. Every year, 3 lakhs worth of DA you will transfer to SPL as depreciation. Okay, sir. So when should you start the depreciation? Sir, depreciation will start not from the day asset is put to use. Put to use is relevant for your income tax act. You will start depreciating when the asset is ready to use. The moment asset is ready to use, we start depreciating. Okay. All right. So now we already studied this. If different components, if different parts have different useful life, means depreciation on that also has to be calculated separately. That is component accounting that I have brought it over here. So which method of depreciation should we choose? AS 16 says choose that method, or AS 16 says choose whatever method you want. But the method of depreciation that you choose should reflect the pattern of economic benefits. It should reflect the pattern of economic benefits that you derive from the asset. Meaning, let's say you have a plant and machinery, you're planning to use it for 5 years. So you want to produce some goods for which you have a plant, you have purchased a plant and machinery, and you will use this machinery for 5 years. For all the 5 years, you will get an output of, or you will be able to produce an output of 1 lakh units. Every year for 5 years, you can generate 1 lakh output. That means output is same. So that means benefit here is the output. If the output is same, means that means which method of depreciation should you go for? That method of depreciation which gives you same depreciation every year, which is straight line method. So if output is same every year, units produced the same every year, then you will go for straight line method. Let's say first year you produce 1 lakh units, next, then year to 80,000, then 50,000. Like this output is going on reducing, means then you will use WDV method of depreciation. Like this. So based on pattern of economic benefits, you will select the depreciation method. Okay. All right. So depreciation method based on revenue is inappropriate. In the ratio of revenue or in the ratio of sales, you should not depreciate, because sales, sir, is not just based on asset. Sales is based on other parameters, like sales, sales is based on the price of the product, quality of the product, economic conditions, competitor action, etc., etc., etc. Yes. So charging the depreciation on asset on the basis of revenue is not correct as per this particular standard. Okay. And a land is a separate asset, building is a separate asset. So you need to separate them and calculate, because land has unlimited useful life. For you to depreciate, useful life should be limited, but land has unlimited useful life. So on land, you don't depreciate. Only on building, you shall depreciate. Hence, you need to separate land and building and accordingly do the recording. Okay. And then every year you check, 3 things you need to check: useful life, salvage value, depreciation method. If there is any change in any of these 3 parameters, it is considered as a change in an accounting estimate, and it is done. Accounting estimate change are always applied prospectively or not retrospectively. One more that could come in your case study is this, we have already discussed. If residual value is greater than or equal to carrying amount, then depreciable base will be DA will not be positive. That means depreciation will be 0. However, if fair value is greater than the cost of carrying amount, depreciation will still arise. Depreciation is based on DA, not fair value. Fair value could be anything. All right. So fair value is irrelevant. In some of the case studies we have seen in RTP numbers, they say fair value is greater than the cost, hence entity has not charged depreciation. That is incorrect. We don't take fair value into consideration for depreciation. We only consider the residual value into picture. That's one. All right. If an asset is classified as held for sale, then the depreciation stops. More about this we'll study in IND AS 105. And useful life, people, is always from management viewpoint. Meaning, let's say there is a property, plant and equipment which can be used for 10 years. It will last for how many years? 10 years. But management wants to use it only for 8 years. It can come for 10 years, but company is saying, or company ka management is saying they want to use it only for 8. That means depreciation you will charge on this PP only by 8 years. That is management viewpoint. Residual, you will take the useful life. Okay. All right. Next is revaluation. Excuse me. Sir, initially, all the PPs are measured at cost. Initial measurement of all PPs at cost. Subsequent measurement, meaning when you buy an asset, you will show an asset at cost. At the end of the year, or at the end of second year, at the end of third year. That's what we mean by subsequent measurement. Subsequently, the company either can go for cost model or revaluation model. Cost model or revaluation model. Cost model means simply you purchase the asset, from that go on reducing depreciation. If there is an impairment, go on reducing impairment. That's all. So whatever value you get, show that in balance sheet. That is nothing but your cost model. So what does revaluation model mean? Revaluation model means to show the asset at fair value, market value. If you want to show the asset at market value, if company wants, then we say they're following revaluation model. Okay. So if company by chance is changing from cost model to revaluation model, first year end they were showing it at cost model, second year end they want to go for revaluation model, or other way around, whatever. All right. If there's a change from cost model to revaluation model or other way around, we call that as a change in accounting policy, and accounting policy changes are always applied retrospectively. All right. Now there's some rules for revaluation. If you're doing revaluation, means the entire class of PPE should be revalued. So what does class of PPE mean? Class means that group of assets which have similar characteristics, a similar nature. Let's say you have 3 furniture. All the 3 furnitures are used for same purpose. More or less they are same. That means all the 3 machineries is one class of asset. Like this. If you have, let's say, 10 building, all the building you're using it for same purpose. That means all the 10 building is one class of asset. Land is a separate class of asset. Building is a separate class of asset. Machinery is a separate class. Jet is a separate class of asset, like this. Okay. Sir, let's say I have an office building and I have an industrial building. Both are same, sir? No. Sir, if you just check, office building structure and usage is very much different from factory building. Right. So factory building is used for production. Office building is used more for, it's a corporate head office, more for a decision making purpose. Yes. So different usage. So if you have office building and factory building, they are not same class. They are a separate class of assets. So let's say a company wants to follow revaluation model for office building. They want to go for cost model for factory building. Is this acceptable? Yes. Because IND AS 16 permits class by class revaluation. Okay. For one class of asset, you can go for cost model. For another class of asset, if company wants, they can go for revaluation model, no harm. All right. But if it belongs to same class, then no partiality is allowed. Let's say in one group of assets, there are 10 assets. In one class of assets, there are 10 assets. Then all the 10 assets, you should either apply cost model or revaluation model. Within class, partiality not allowed. Across different class, you can do partiality. Meaning for one, you can follow cost, another one, you can follow revaluation model. Okay. Now the treatment part. Sir, first time you did a revaluation, or maybe let's take an example and prove this. Let's say there is a land, a non-depreciable asset, because accounting is different for depreciable asset and non-depreciable asset. I'll take non-depreciable asset first and try to explain it to you. Let's say there is a land, right? Let's say the carrying amount of land is 10 lakh because you purchased it for 10 lakh. At the year end, the fair value of the land is 15 lakh. Okay. So this is year 1 beginning. This is year 1 ka ending. And company wants to follow revaluation model. That means they want to short at fair value. So first time they did a revaluation, they are having a happy phase or a sad phase. They bought it for 10, fair value is 15 lakh. That means value has increased. So it's a profit scenario. So first time when they did revaluation, they got a gain. Where will they transfer this gain to? This gain, have they realized it? No, this is unrealized gain. All unrealized gain will be transferred to revaluation reserve or revaluation surplus. That is an OCI item. And this is a non-recyclable or reclassifiable OCI item. Okay. All right. So whatever gain they get here, what is the gain here? 10 lakh minus 15 lakh, which is 5 lakh, will be transferred to revaluation surplus, which is an OCI. Okay. Next year, let's say in year, this is year one drama. Year 2, let's say now 1 minute. Year 2 end, carrying amount, what is the value of the land now? 15 lakh. From first year, from 10, you increased it by 5, and now its value has become 15. Again, second year, no, you checked the revaluation. Now the fair value of the land has become only 7 lakhs. Okay. Obviously, companies following revaluation model. Revaluation model means they have to show it at fair value. Now it's a case of revaluation gain or revaluation loss. Now it's a case of revaluation loss. Loss means you'll transfer to P&L. No. Subsequently, when you did revaluation and if you get a loss, entire loss will not be transferred to P&L. How much gain you got initially? So out of this 8 lakh loss, 5 lakhs will be first adjusted with revaluation surplus. Because when you got gain, you parked it in revaluation surplus. No. Subsequently, when you get a loss out of 8 lakh loss, 5 lakh loss will be adjusted with revaluation surplus. Balance loss of 3 lakh only will be transferred to SPL account. That is what I've written over here. Okay. So what if it's the other way around? First time if you get a loss, first time you did revaluation and if you get a loss, that loss will be transferred off to P&L account. Second year, let's say, or subsequent, it's not necessary, it has to be second year. In future, if you did revaluation and if you get a gain, first year you got loss. Let's say first year you got a loss of 10 lakhs. You transfer to P&L. In year 3, you did revaluation. You got a gain of, let's say, 15 lakh. 15 lakh gain. Entire gain will you transfer to revaluation reserve? No. Out of this 15 lakh gain, initially how much loss did you book? 10 lakh loss you booked it in P&L. No? So the 10 lakh gain, 10 lakh worth of this gain, you transfer it to SPL. Balance 5 lakh gain only, you transfer it to revaluation surplus, that is OCL. That wala adjustment this is all about. Okay. Alright. Now when it comes to accounting. Accounting, maybe we'll learn it with the help of one question. There are two approaches. Maybe quickly I'll tell this and go for this. One approach is whatever accumulate, or maybe let's do a thing. Let's learn it with the help of question only. I think it's much better. Let's come for question number 3. Jupiter Limited has an item of property, plant and equipment with an initial cost of 1 lakh. Initial cost meaning original cost is 1 lakh. On the date of revaluation, accumulated depreciation is 55,000. So far, you already depreciated by 50,000. Okay. Fair value of the asset reference to the transaction is assessed as 65. So first of all, what is the carrying amount of the asset? Originally, you bought it for 1 lakh. You have depreciated it by 55. So carrying amount is 45. But the fair value of the land is 65. So that means this is the case of revaluation gain. How much gain? 45 has become 65, which is 20,000. Alright. So there are two ways to book a gain, revaluation gain. Sir, simple entry, no sir, PP account debit to revaluation surplus. No. If it was non-depreciable asset like land, that entry will hold good. If here this PP is a depreciable PP, right? If there is a depreciable PP, there are two ways in which you can pass the entry or route the entry for this. First entry is, sir, you maintained here accumulated depreciation. Accumulated depreciation means company is following something called provision for depreciation method. There are two ways in which you can account depreciation. First is called the charge method. Another one is called accumulated depreciation method or provision for depreciation method. If you follow charge method, in your golden days, what is the entry for depreciation? First entry you pass is depreciation account debit to PP. And the second entry is P&L account or SPL account debit to depreciation. If you are following this, we say company is following charge method. There is another method called accumulated depreciation method. If accumulated depreciation method is followed, no, the journal entry for depreciation will be same. Depreciation account debit, but they will not credit PP account. Instead of crediting PP, they will write provision for depreciation account. Okay, or another name for provision for depreciation is accumulated depreciation. And this depreciation will be transferred off to P&L account. So SPL account debit to depreciation is the second entry. Okay. Now, in this problem, they are maintaining provision for depreciation account. So that means they are following this wala drama. Now, if you just check here, what is the entry for depreciation they would have passed? Accumulated depreciation is 55,000. That means they have depreciated this asset totally to the extent of 55,000. First, they bought the asset. When they bought the asset, the journal entry they would have passed is PP account debit to bank. How much did they buy this asset for? 1 lakh. That means they have passed this entry. Now, for depreciation, they have passed depreciation account debit to provision for depreciation. That means whenever you follow provision for depreciation method, no, fixed asset ledger balance will always be at original cost. And what is original cost here? 1 lakh. Because all depreciation is not being reduced from PP ka ledger. It is transferred to provision for depreciation ka ledger. So whenever you maintain provision for depreciation method, fixed asset will always be shown at original cost. Okay. Hence, whenever there is a revaluation gain, first thing what you do is reverse the depreciation. Whatever accumulated depreciation you have passed till now, first reverse that. How much depreciation have you charged so far? 55,000. That provision for depreciation or accumulated depreciation has what balance? Credit balance. Reverse it. To reverse what we have to do? Debit it. So the journal entry you will pass is provision for depreciation account debit. How much? 55,000. Another name for provision for depreciation is accumulated depreciation. Is that okay? To what account? To PP account you write, which is what? 55,000. So when you do this, what will happen? Sir, initially PP was shown at 1 lakh. Now you have credited by 55. That means PP ka ledger balance will become from 1 lakh minus 55, it will become 45,000. Basically, by passing this entry, you will get the PP to its carrying amount. That's what. So whatever depreciation you passed, you reverse it. When you do the reversal, the PP will be brought back to its carrying amount. Now you pass the revaluation entry. Now the fixed asset ka ledger balance is 45. But company wants to follow revaluation model. So what is the fair value of the asset? Fair value of the asset is 65. From 45 PP ka ledger balance, you need to increase and bring it up to 65,000. So the gain is 20,000. So PP ka ledger balance, you need to increase. So the journal entry will be PP account, asset account debit to revaluation reserve 20,000, 20,000. Okay. This is the one. This is the easiest one. I recommend you to follow this in exam. Simply reverse the accumulated depreciation. Then whatever is the revaluation gain, pass the entry. Asset account debit to revaluation reserve. That is one entry. Okay. What is the second method? Second method is first check. What is the carrying amount of the asset? 45. What is the fair value? 65. How much is the gain? 20,000. First find out the gain percentage. Gain percentage. From 45, it became 65. So the gain is 20,000. Gain percentage is how much? How do you calculate the gain percentage? Gain amount, which is 20,000, divided by original amount, which is 45 into 100. If you do this, 20 divided by 45 into 100, if you do, you're going to get 44%. So the gain percentage is 44%. Now this method, what it says is, you don't have to reverse accumulated depreciation. Simply increase asset ka ledger also by 44%. Provision ka ledger also you increase by 44%. Asset ka has debit balance. How do you increase it? Again debit. So asset account debit. Currently asset is shown at 1 lakh. 44% you need to increase. So 1 lakh ka 44% will be 44,444. Not only that, even accumulated depreciation you need to increase. Accumulated depreciation or provision for depreciation has credit balance. Again to increase, what we'll do? Again credit. How much you need to increase it by? 44%. Currently what is the value? 55,000. 55,000 you need to increase by 44%. So 55,000 into 44% if you do, you're going to get 24,444. So you're debiting by 44,444, you're crediting by 24,444. Is journal entry matching? No. There is a difference of 20,000. That is nothing but your revaluation gain transferred off to P&L or transferred off to revaluation reserve. This is second method. Alright. Sorry, exam what to do? Check the marks. If it comes to 2 marks, mention only one. I think, yeah, I mean, personally, you have a choice to do whatever you want. So one method should be good enough. Okay. Or if you want to play it safe, call out both the methods. Okay. So this is about revaluation ka drama. Okay. Then what, sir? Alright. Now, any excess depreciation if you're getting due to revaluation. Sir, if there is a revaluation gain, no? Carrying amount of the asset, in the previous example we saw from 45 it became 65. So due to revaluation gain, carrying amount of the asset will increase. Sir, if carrying amount increases, depreciation also will increase, right? So after revaluation, carrying amount will increase. So after revaluation, depreciation also will increase. Let's say before revaluation, depreciation was, before you did revaluation, one asset was depreciated every year to the extent of 1 lakh, assumption. After revaluation, carrying amount increased, so depreciation also increased. Let's say it became 1,30,000. Before revaluation it was 1 lakh. After revaluation it became 1,30,000, assumption. That means, is there any excess depreciation or increase in depreciation? Yes. Due to revaluation, you are getting extra depreciation. How much is that? Before revalue it was 1. After revaluation it has become 130, means excess depreciation which is coming only due to revaluation is 30,000. So what IND AS 16 says is, any excess depreciation that you are getting due to revaluation, that can be directly transferred to retained earnings. Meaning, so here, how much is the depreciation now? After revaluation, it has become 1,30,000. So this depreciation, you will transfer it to P&L to the extent of 30,000. 1,30,000. So whatever is the depreciation after revaluation, you will transfer it to P&L. How much is the excess depreciation you are getting due to revaluation? 30,000. That to know, from revaluation surplus, directly you can release it into retained earnings. So meaning you will pass the entry revaluation surplus, that is OCI account debit. How much? Revaluation reserve has credit balance. This 30,000 of revaluation surplus, you are releasing it into retained earnings. So revaluation surplus ka balance will reduce and this 30,000 will be released to directly into retained earnings. Okay. So this is one option. There's not a compulsion. If company wants, whatever excess depreciation is there, they can transfer from revaluation reserve to retained earnings. Or if they don't want to do this 30,000 wala entry, that is also acceptable. Totally company ka choice. Okay. All right. This is about revaluation. Next will be, sir, for how long will this revaluation surplus be there, sir? Sir, as long as the asset is there, revaluation surplus also will be there. If you have de-recognized the asset due to whatever reason, you sold the asset, you written off the asset, your FEB stops. One of the criteria to show PP is there should be future economic benefits. So if FEB stops, asset also will be de-recognized. So if asset is de-recognized, well, then whatever balance is there in revaluation reserve will be transferred off to retained earnings. Okay. All right. Now this is all right. And how often should you do revaluation, sir? So if the asset is very volatile, you have to do revaluation every year. You need to do revaluation, meaning annual revaluation is necessary. Otherwise, once in 3 to 5 years, if you do revaluation, that is good enough. So this is about frequency of revaluation. Derecognition. Derecognition means cancellation of asset. So you will cancel the asset when when the FEP stops or when you sell the asset, etc., etc. On derecognition, whatever profit or loss you made on sale or return of whatever, that will be transferred off to P&L. Disclosure is fine. So that's about, yeah, I think I'll just check. Yeah. That should be, or maybe just one question, maybe quickly we'll review off. Sun Limited purchased some land for 10 million. In fact, the requirement here is you need to find out the carrying amount of factory at year end. They will give you various expenditure. You simply need to find out, consider all that and get the carrying amount at the year end. So you purchased the land, okay? To construct obviously factory, you need a land. So land cost can you add? Yes, land. They've expressed everything in 1,000. So 10 million will become 10,000. All right, including legal cost. Yeah, this 10 million includes legal cost. So legal cost should be added because it is DAC. So they've already added grade in order to construct a new factory. Construction commenced on 1st May. All right, they've incurred many expenditure. Leveling cost can you add? Yes, 300 you can add. They're expressing everything in 1,000. All right, because all these are DAC. Employment cost for construction, again a DAC. Can you add? Yes, it is 2 lakh every month. Sir, you started construction in May. The factory was completed on 30th November. So May, June, July, August, September, October, November. So construction went for 7 months. Every month the salary is 2 lakh. For 7 months it will be 14 lakhs. 14 lakh you can add up. On the material cost also you can add up. Yes. Then overhead costs. So generally, general administrative overhead and all you transfer it to P&L. But here check what are they saying? Overhead cost directly related to construction. Overhead cost to transfer it to P&L, but here they've used the word directly related to construction. So this is not general overhead, it is specific overhead. That is the reason we are adding. We will add. In fact, 1 lakh per month. How many months? 7 months. So 1 lakh into 7, which will be 7 lakh. All right. Ongoing overhead cost allocated. Allocated overhead is general cost that will not be added. It will be ignored. Okay. It will be in fact transferred off to P&L. It cannot be capitalized to PP. Okay. Then what about next? Income received during temporary use of premises, car parking. This only we call it as incidental incidental operation ka income or expense. Incidental operation ka income or expense will not be capitalized, meaning rather it will be transferred off to P&L. Here it's an income. This will also going off to SPL only. It will not be capitalized. Cost of relocating expenditure, opening ceremony expenditure. Again, all this also cannot be capitalized. Okay. Production began on 1st February. Sir, factory was completed on 30th November. It was put to use on 1st February, but it is available for use from 30th November. So depreciation will start from 30th November, not 1st February. That means in the current year, you will depreciate for December, January, February, March. So the depreciation in the current year will be for 4 months. Overall useful life of the factory building was 40 years. Okay. However, it's estimated that the roof will need to be replaced 20 years after completion. So that means, obviously, we know different components have different useful life, means we need to calculate depreciation separately. Roof have to be depreciated over 20 years. Other parts can be depreciated over 40 years. Okay. And the cost of replacing the roof at current price will be 30% of the cost of building. 30% of the cost of building, indirectly they're saying, constitutes roof cost. Okay. Then what's it? At the end of 40th period, that is a life, Sun has a legally enforceable obligation to demolish the factory to restore. There's nothing but your DSR cost. The total DSR cost they're saying is 20 million. Total DSR cost will we add? No. We find out present value of DSR cost. How do you find out present value of DSR cost? Take the future value and multiply it by the discount factor. Here they only calculated discount factor TVIF at 8% is 0.046. So 20 million into 20 million is nothing but 2 crore. 2 crore into 0.46 will give you 9,20,000 or whatever. That is your present value of DSR cost, which should be added up, which can be added or which is added in fact. Okay. Then construction was partly financed by a loan. This is a borrowing cost. And Ind AS 23 says if you have any qualifying asset, then borrowing cost relating to qualifying asset will not be transferred to P&L, but rather it will be capitalized. So you can you add this interest? Yes. 17.5 million loan you took it from 1st April, but construction began only from 1st May. So from April you can't capitalize. You can only capitalize from May to November. That is only for 7 months. So what is the interest rate? 6%. So 17.5 million, where is that? 1.75 crores. Interest rate is 6%. Only 7 months ka interest will be capitalized, which is 6,12,500. Then they're saying what? Sun Limited received any investment income 1 lakh from temporary investment. Sometimes, no, again, see, you got the loan on 1st April, but construction is beginning only on 1st May. So for 1 month, the fund is idle. No company will keep the funds idle. They'll generally invest. So Ind AS 23 says, if you have received any investment income out of this, so entire interest cannot be capitalized. Whatever temporary investment income you have earned, that needs to be subtracted. So this 1 lakh has to be reduced. Okay. So do all this, you will get the total cost of the building, which is this. Okay. This 19,000 includes land also. Land cannot be depreciated. First, remove the land. Land element is 10,000. So that means what is the remaining? 9,912 is the total cost of building. Now in this total cost of building, one other roof has a useful life of only 20, other has a useful life of 40. So in 9,992, 30% will relate to roof, 70% will relate to others. So how much will be the depreciation relating to roof? 9,912 into, in fact, they've given here only 9912 into 30%. Okay. Roof you has a depreciation life of only 20 years. So you will depreciate by 20 years. So if you do divided by 20, you will get full year ka depreciation. Current year, can we charge full year ka depreciation? No. Asset is ready only from November and year is ending on March. So December, January, February, March. So you will depreciate only for 4 months. So into 4 by 12, that you will get depreciation related to roof basis. Another part will be 70%. So 9912 into 70%. The other part's life is 40 years. But this year you will depreciate only for 4 years. That's your depreciation amount. Okay. All right, people. This was a quick revision on IND AS 16. Thank you.